What if I told you that the secret to building lasting wealth isn't hidden in a complex algorithm, a secret trading signal, or the next revolutionary cryptocurrency? What if the most powerful financial strategy ever devised is actually boring? So simple, so straightforward, that Wall Street spends billions of dollars a year trying to convince you it doesn't work. Welcome to Capitura. Today, we're going to pull back the curtain on the entire financial industry. We're not just looking at a book. We are exploring a revolution disguised as common sense. This is your complete guide to John C. Bogle's masterpiece, The Little Book of Common Sense Investing. Introduction: The Rebellion of Simplicity. John C. Bogle wasn't just another Wall Street executive. He was a titan, a disruptive force who, in 1975, did something so radical it was initially mocked as un-American. He founded the Vanguard Group and, shortly after, created the world's first index mutual fund, the Vanguard 500. His idea was painfully simple. Instead of paying expert a fortune to try and beat the stock market, why not just buy the entire market and hold it forever? This wasn't just a business decision. It was a declaration of war against the established order. The financial industry is built on the promise of expertise, on the idea that smart, well-paid managers can find needles in the haystack of the global economy. They sell you the dream of outperformance, of getting an edge. Bogle's message was blunt. It's a dream that, for the vast majority of investors, will never come true. The game is rigged, not by criminals in the shadows, but by the very structure of the system, by costs. The relentless, compounding drag of fees, commissions, and expenses is the single greatest enemy of your long-term returns. His book, The Little Book of Common Sense Investing, isn't just a collection of tips. It's the manifesto of this revolution. It's Bogle's final, powerful argument, distilled into its purest form, for the individual investor to reclaim their financial future from a system designed to profit from their activity, not their success. But here we are, decades after Bogle first launched a crusade. Does this simple, common-sense approach still hold up? We live in a world Bogle could have barely imagined, a world of zero-commission trading apps on our phones that turn the stock market into a video game, a world where fortunes are seemingly minted overnight in cryptocurrencies with no underlying value, a world of meme stocks, where armies of retail investors on Reddit can challenge billion-dollar hedge funds. We are bombarded by financial influencers on TikTok, a constant stream of stock tips, and the ever-present fear of missing out, the dreaded FOMO. This is precisely why Bogle's wisdom is more essential today than ever before. His book is a perfect antidote to the chaos of modern finance. Think about the Robinhood culture. It has democratized access to the markets, which is a wonderful thing, but it has also gamified investing, encouraging rapid, speculative trading. Bogle would argue this is a classic loser's game, where the more you trade, the more you fall behind, letting transaction costs and poor timing eat away at your returns. Every time you see someone hyping a stock like Tesla, urging you to go all in based on a gut feeling or a charismatic CEO, Bogle's ghost is whispering, are you investing or are you speculating? Consider the rise of Bitcoin and cryptocurrencies. These assets have created immense wealth for a few, but they represent the ultimate speculation. They are non-productive assets. They don't generate earnings or dividends. Their value comes purely from what the next person is willing to pay for them. Bogle built his philosophy on owning businesses, real companies with real profits. He would see the crypto craze not as an investment revolution, but as a massive, digital age speculative bubble, a modern-day tulip mania. And what about the FIRE movement? Financial independence. Retire early. This is a movement built on the dream of escaping the rat race through aggressive saving and investing. Many of its most successful proponents have built their entire strategy on the foundation Bogle laid, a low-cost, diversified portfolio of index funds. They're living proof that his boring method is the most reliable path to true financial freedom without needing to gamble on the next hot stock. Bogle's work provides a compass in this dizzying modern landscape. It teaches you to separate the signal from the noise. The signal is the slow, steady, compounding growth of global business. The noise is everything else. The daily market commentary, the expert predictions, the hype cycles, the get-rich-quick promises. So, In this complete summary, we will walk through Bogle's timeless principles chapter by chapter. We won't just tell you what he said. We'll show you how his ideas directly apply to the challenges and temptations you face as an investor right now, in 2025. This isn't just a book report. It's a blueprint for financial sanity in an age of insanity. Prepare to have your perspective on investing change forever. A parable, the Gottrocks family. Bogle begins not with charts or data, but with a story. It's a simple parable that perfectly frames the entire book. Imagine a wealthy family, the Gottrocks. Together, they own every single stock in corporate America. They own all of it. Each year, corporate America generates profits and pays out dividends, and all that money flows directly to the Gottrocks family. They are, as a whole, capturing 100% of the market's return. They are winning. But then, some of the younger, more ambitious Gottrocks cousins get a bright idea. They think they can be smarter than the rest of the family. They hire professional helpers, money managers, brokers, and consultants to help them pick and choose which of the family stocks to own. They start trading amongst themselves, each one trying to outsmart the other. What happens? The family, as a group, still owns all corporate America. That fact hasn't changed. Their total return before costs is still the exact same market return. But now, they are paying enormous sums to their helpers. The money managers take a fee. The brokers take a commission on every trade. The consultants charge their advice. All these costs come directly out of the family's pockets. So, the Gottrocks family, as a group, is now guaranteed to earn less than the market return. They have transformed a winner's game, simply owning all the businesses and collecting all the profits, into a loser's game, where they fight over the same pie while the helpers run away with a huge slice of it. Today's take. This parable is more potent than ever. Today, the helpers are not just traditional money managers. They are the zero-commission trading platforms that make money on order flow. They are the crypto exchanges charging non-transparent fees. They are the creators of complex thematic ETFs with high expense ratios that promise to capture the next big trend, whether robotics, cannabis, or AI. They are the social media influencers whose real business is selling you a course or getting you to use their affiliate link. The Gottrocks family is all of us, the community of investors. When we all try to beat the market by trading frantically, we collectively fail. The only guaranteed winners are the intermediaries who facilitate our hyperactivity. Bogle's story is a timeless reminder. The most effective way to win is to refuse to play the loser's game. Own the whole haystack. Pay as little as possible for the privilege, and let the magic of compounding do the work for you. Chapter 1. A Case for Indexing. Here, Bogle lays out his central thesis with the force of irrefutable logic. He calls it the simplicity theory. He argues that successful investing is not about picking winning stocks or timing the market. It's about owning a diversified portfolio of all businesses and holding it for the long term. The best way to do this? Through a low-cost index fund that simply tracks the market, like the S&P 500. Bogle's argument is mathematical, not emotional. He explains that for every buyer of a stock, there must be a seller. For every investor who is above average, there must be one who is below average. When you factor in the cost of playing the game, the management fees, trading costs, and taxes, the average investor is mathematically guaranteed to underperform the market. The market's return, minus the cost of investing, equals the net return that investors actually receive. It's what he calls the cost matters hypothesis. He presents data showing that over long periods, the vast majority of actively managed mutual funds fail to beat their benchmark index. They might have a good year, or even a good 5 years, but the relentless drag of their higher fees and trading costs eventually catches up to them. The winning strategy, therefore, is to accept the market's return by buying and holding an index fund, minimizing costs to ensure you keep as much of that return as possible. It's a strategy that guarantees you will beat the majority of professional investors over the long run. John C. Bogle's opening chapter, A Case for Indexing, is not merely an introduction to a financial strategy. It is a foundational argument intended to completely reframe the reader's perception of the entire investment universe. He begins not with a whisper, but with a thunderclap, presenting a thesis so simple and yet so profound that it directly challenges the multi-trillion-dollar global asset management industry. This chapter serves as a bedrock upon which every subsequent argument in the book is built. It methodically constructs a case, piece by logical piece, that the most effective, reliable, and ultimately successful investment strategy for the overwhelming majority of people is to simply buy a fund that holds every stock in the market and then do nothing. This is Bogle's simplicity theory, a concept that posits that the complexities and supposed sophistication of modern finance are not beneficial features for the investor, but rather a smokescreen designed to justify the exorbitant costs that systematically drain wealth from the public. He argues that the financial markets, in their essence, are a straightforward proposition. Businesses create value, and as an owner of those businesses, you're entitled to a share of that value. The index fund is the purest expression of this ownership, a vehicle that allows you to participate in the collective genius and entrepreneurial spirit of the entire economy, without falling prey to the destructive behaviors and costs that plague the world of active management. The core of Bogle's argument is not based on opinion, forecasting, or elaborate economic theory. It is rooted in the unyielding, immutable laws of arithmetic. He presents what he terms the cost matters hypothesis, a principle that is as elegant as it is devastating to the proponents of active management. Before any costs are considered, the stock market is a zero-sum game. For every single transaction, there is a buyer and a seller. For every investor who outperforms the market average, another must underperform by a precisely equal amount. The collective of all investors in aggregate is the market. Therefore, the return earned by all investors as a group must and will be the exact return of the market itself. This is a mathematical certainty, as inescapable as the law of gravity. It is the starting point from which all investment reality flows. From this neutral, zero-sum before cost reality, Bogle introduces the villain of his story, cost. The moment you introduce the real-world cost of investing, the management fees paid to portfolio managers, the brokerage commissions on trades, the administrative expenses of running a fund, the marketing budgets, and the taxes on realized gains, that zero-sum game is irrevocably transformed. It becomes a loser's game. The collective of investors is now mathematically guaranteed to underperform the market because the total market return must be reduced by the total cost of financial intermediation. The slice of the pie taken by Wall Street is a direct, dollar-for-dollar reduction in the returns available to Main Street. This realization is the intellectual cornerstone of indexing. If investors as a group are destined to underperform the market after costs, then the logical path to superior performance is not to try harder to find winning stocks, but to simply minimize the costs that are dragging down the average. An index fund, by its very nature, is designed to do exactly this. It doesn't employ teams of highly paid analysts to conduct proprietary research. It doesn't engage in the frequent buying and selling of securities, which racks up trading costs. It simply follows a predetermined set of rules. Own all the stocks in a given benchmark, such as the S&P 500 or the total U.S. stock market, in their precise market proportions. The result is a dramatic reduction in operational costs. While a typical actively managed fund might charge an expense ratio of 1%, 1.5%, or even more, a broad market index fund can be operated for a tiny fraction of that, often less than 1/20%, a few basis points. Bogle presents this not as a minor advantage, but as a single most decisive factor in long-term investment success. Over an investment lifetime, the seemingly small difference in annual fees will compound into a colossal divergence in outcomes, potentially consuming more than half of an investor's rightful returns. The index fund guarantees you your fair share of the market's bounty. The high-cost active fund guarantees you will receive significantly less. To illustrate the futility of active management, Bogle presents historical data as his star witness. He demonstrates, with chart after chart, that over any meaningful long-term period, 10, 20, 50 years, the vast, overwhelming majority of actively managed mutual funds fail to outperform their benchmark index. A few may succeed for a year or even 3, often due to sheer luck, like a lucky streak at a poker table. But as time stretches on, the relentless drag of their higher costs and the statistical difficulty of consistently outsmarting millions of other smart, well-informed market participants grinds them down. The data proves that the promise of outperformance, the very product that the active management industry sells, is a promise that is almost never kept. This is a direct, evidence-based refutation of the idea that professional expertise can reliably overcome the handicap of costs. Bogle argues that investors are conditioned to believe in the myth of the star manager, the financial guru with a golden gut who can see the future. The industry spends billions on marketing to perpetuate this myth, celebrating short-term winners and burying the evidence of their long-term failures. Bogle's work in this chapter is an attempt to arm the average investor with the simple, powerful truth that can inoculate them against a seductive but ultimately false narrative. The winning strategy is not to find a rare, lucky manager who might defy the odd for a while. The winning strategy is to accept the market's return through an index fund and, by minimizing costs, guarantee that you will outperform a vast majority of your fellow investors, professionals included, over the long run. The principles laid out in this first chapter find their perfect, almost tragic modern-day case study in the rise and fall of Cathie Wood and her ARK Innovation ETF, the ARKK. During the technology-fueled bull market of 2020, ARKK became a global phenomenon. It was positioned not just as a fund manager, but as a visionary, a prophet of disruptive innovation who was investing in the future. The fund's returns were astronomical, far outpacing the boring S&P 500. Millions of retail investors, many of them new to the market and active on platforms like Robinhood, poured billions of dollars into the fund. They were not just buying an investment. They were buying a story, a belief in a brilliant manager who had cracked the code. This was the myth of the star manager playing out in real time, amplified by the echo chamber of social media. Investors were chasing past performance, the very behavior Bogle warned against, believing that the fund's spectacular recent history was a predictor of its future. Bogle's framework would analyze the situation with devastating clarity. He would point out that ARKK's strategy of making highly concentrated bets on speculative, often unprofitable, technology companies was the polar opposite of owning the diversified haystack. It was an attempt to find a handful of very specific needles. Furthermore, ARKK's expense ratio, at 0.75%, was more than 20 times higher than that of a simple S&P 500 index ETF. According to Bogle's cost matters hypothesis, this created a massive, permanent handicap that the fund would have overcome just to break even with the market. Then came the inevitable reversion to the mean. As market conditions changed and enthusiasm for speculative growth stocks waned, ARKK's performance collapsed, with the fund losing over 75% of its value from its peak. The crucial point, which Bogle's work allows us to see, is that the vast majority of investors in the fund experience returns far worse than the fund's own reported numbers. This is because the bulk of the money flowed in after the period of spectacular performance, near the peak of the hype. Investors collectively bought high, driven by FOMO, and then many were forced to sell low as their losses mounted. They played the loser's game perfectly. The ARKK saga is not an indictment of Cathie Wood's intelligence or conviction. It is a powerful, real-world validation of Bogle's timeless, arithmetic-based principles. It demonstrates that even the most compelling narratives and celebrated managers are ultimately subject to the relentless rules of cost, diversification, and market gravity. An investor who simply held a low-cost S&P 500 index fund through that same period not only avoided the catastrophic losses, but also participated in the steady, underlying growth of the broader economy, their journey marked by peace of mind rather than panic. Bogle's argument in Chapter 1 also serves as a powerful psychological corrective for the modern investor, who is constantly bombarded with stimuli designed to provoke action. The entire architecture of the modern financial media and brokerage industry is built on the premise that you should be doing something. Checking stock prices, reading analyst reports, listening to market commentary, executing trades. This activity creates the illusion of control. Bogle systematically dismantles this illusion. He shows that for the long-term investor, most of this activity is not just useless, it is counterproductive. It is noise, not signal. The true signal is a slow, compounding growth of corporate earnings and dividends over decades. The noise is everything else. The index fund is a revolutionary device because it is a commitment to the signal. It is a conscious decision to ignore the noise. By buying the entire market, you are admitting that you do not know and do not need to know which company will invent the next life-changing technology or which sector will be tomorrow's leader. You are expressing a humble confidence not in your own ability to predict the future, but in the collective ability of human enterprise to create value over time. This is a profound shift in mindset. It transforms investing from a stressful, ego-driven hunt for superiority into a calm, disciplined process of accumulation. The question is no longer, how can I beat the market? But rather, how can I best harness the power of the market? Bogle's answer is clear. You harness its power by participating in it fully, cheaply, and with as little friction as possible. This approach is fundamentally at odds with the culture of constant engagement promoted by modern trading platforms. These platforms have gamified investing, using behavioral prompts, social features, and a seamless user interface to encourage frequent trading. Bogle would see this not as a democratization of finance, but as a mass weaponization of investors' worst emotional impulses. He would argue that the most valuable feature a brokerage platform could offer is one that encourages you to do less, not more. In this context, the simple, boring index fund is not just a financial product. It is an act of rebellion. It is a declaration of independence from the noise machine of Wall Street and the emotional roller coaster of daily market fluctuations. It is a choice to align your portfolio with the long, slow, upward march of economic progress rather than the chaotic, random walk of short-term market sentiment. Expanding on the idea of owning the haystack, Bogle's initial chapter makes a case that is even more compelling in the 21st century than it was in the 20th. The global economy has become vastly more complex and interconnected. The sources of future growth are more unpredictable than ever. In the 1970s, an investor might have reasonably believed they could analyze the major players in the U.S. economy. Today, trying to understand competitive dynamics between thousands of global companies in fields like artificial intelligence, biotechnology, and renewable energy is a task beyond the capacity of even the most brilliant individuals. The haystack has grown exponentially larger and more intricate. Therefore, the wisdom of simply buying the whole thing has grown in proportion. An investor in a total market index fund in the 1990s would have owned a small, unknown online bookseller called Amazon. They would have owned a struggling computer company called Apple. They would have owned a search engine startup called Google. They didn't need to have the foresight to identify these future giants. They simply needed the wisdom to own every company, allowing the market's own ruthless efficiency to sort the winners from the losers. The index fund is a mechanism that automatically adjusts its holdings to reflect the changing landscape of the economy. As companies grow and become more valuable, they naturally become a larger part of the index, and thus a larger part of your portfolio. As companies falter and shrink, their weighting in the index and in your portfolio diminishes. It is a self-cleansing, self-optimizing system that harnesses the market's collective wisdom. You are, in effect, outsourcing the task of picking winners to the entire global marketplace. This is a far more reliable and powerful mechanism than relying on the judgment of a single fund manager or your own research. Bogle's argument is that this is not a passive strategy, but rather a profoundly active choice to trust the market mechanism itself. It is the ultimate diversification, not just across companies and industries, but across future unknowable outcomes. In an age of unprecedented technological disruption and geopolitical uncertainty, this strategy of owning everything offers a robustness and peace of mind that a concentrated portfolio of hand-picked stocks could never provide. It ensures that no matter where the next wave of innovation comes from, you will have a piece of it. Finally, Chapter 1 establishes the intellectual and moral high ground of the indexing argument. Bogle frames passive investing not as a strategy for those who are content with average returns, but as the most logical and rational choice for intelligent investors. The term average is misleading. By capturing the market's return with minimal cost, the index fund investor is virtually guaranteed to achieve a final result that is decidedly above average relative to a universe of other investors who are all paying higher costs and making behavioral errors. The pursuit of beating the market is, for most, a siren song that leads to a place of financial mediocrity or worse. Accepting the market's return is a path to achieving your financial goals with the highest degree of probability. There is a deep intellectual honesty to this approach. It is an acknowledgement of the limits of prediction in a complex system. It is a rejection of the ego-driven need to feel smarter than everyone else. Bogle's tone throughout this chapter is that of a patient, passionate educator, attempting to strip away a lifetime of financial industry marketing and reveal the simple, underlying truth. He is not selling a product. He is explaining a mathematical reality. This is why his message has resonated so powerfully and created a legion of followers known as Bogleheads. They are investors who have embraced this philosophy not as a get-rich-quick scheme, but as a get-rich-surely, or at least as surely as possible, framework. The chapter concludes by solidifying this core thesis. The game of trying to beat the market is a zero-sum game before costs and a loser's game after costs. The only way to win a loser's game is to refuse to play it. Instead, you should play the winner's game, which is to capture the entire return of the market at the lowest possible cost. This simple, powerful idea, laid out with such clarity and conviction in this first chapter, serves as the unshakable foundation for every other piece of advice in the little book of common sense investing. It is the starting point for a revolution in personal finance, empowering millions to take control of their financial futures by embracing profound power of simplicity. Today's take. This argument is a direct challenge to the modern cult of the star fund manager. Think of Cathie Wood and the ARK Innovation ETF. During the tech boom of 2020, she was hailed as a genius, a visionary who could see the future. Her fund delivered spectacular returns and money poured in. But as the market turned, those same high-flying stocks crashed, and the fund dramatically underperformed the simple, boring S&P 500 index fund. Investors who chase those hot returns learned a painful lesson that Bogle taught decades ago. Yesterday's winners are rarely tomorrow's winners. The hype cycle is powerful, but math is more powerful. By trying to find the next Cathie Wood, you are playing a game of chance. By buying a total market index fund, you are harnessing the collective power of thousands of businesses and ensuring that you capture the market's long-term growth, whatever that may be. You own a piece of tomorrow's winners before anyone even knows who they are. Chapter 2. The Relentless Rules of Humble Arithmetic. Bogle dives deeper into the math of why costs are so destructive. He introduces a simple but devastatingly powerful concept: the tyranny of compounding costs. We all love to hear about the magic of compounding returns, but we rarely consider that costs compound right alongside them, working in reverse. He asks you to imagine two investors, both starting with $10,000. They both invest for 50 years in a stock market that returns an average of 7% per year. Investor A buys a low-cost index fund with an annual expense ratio of 0.1%. Investor B invests in an actively managed fund with a seemingly reasonable expense ratio of 2%. After 50 years, the difference is staggering. Investor A, the index fund investor, would have approximately $280,000. Investor B, the active fund investor, would have only about $100,000. Where did the other $180,000 go? It was eaten alive by that 2% fee, compounded year after year. It didn't just disappear. It was transferred from the investor's pocket to the pocket of the fund management company. Bogle's point is brutal. Over a lifetime of investing, the fees you pay can consume the majority of your potential returns. He argues that investors are often fooled by short-term thinking. A 2% fee doesn't sound like much in a single year, especially if the market is up 20%. But over decades, it's a financial cancer. He hammers this point home. In the world of investing, you get what you don't pay for. Today's take. This is perhaps the most important chapter for the modern investor. The financial industry has become incredibly creative at hiding costs. Crypto exchanges, they often advertise low trading fees, but bake in massive spreads. The difference between the buy and sell price, which act as a hidden tax on every transaction. Robo-advisors, while often cheaper than human advisors, they still charge a management fee on top of the expense ratios of the ETFs they put you in. You're paying a fee on top of a fee. Thematic ETFs. Want to invest in disruptive tech, clean energy, or the metaverse? There's an ETF for that. But these niche funds often come with much higher expense ratios than a simple total market fund. The provider is selling you a story, and you're paying a premium for it. Bogle's Humble Arithmetic is a powerful shield. Before you invest in anything, you must ask, what is the total All-in cost? What is the expense ratio? Are there trading fees, spreads, advisory fees? Every single basis point, every 100% matters. Ignoring costs is like trying to fill a bucket with a hole in it. You might not notice a leak at first, but over time, you'll wonder why it's empty. Chapter 3. How most investors turn a winner's game into a loser's game. In this chapter, Bogle shifts from the structural flaws of the industry to the behavioral flaws of investors themselves. The stock market, over the long term, is a powerful engine of wealth creation, a winner's game. So, why do so many people do so poorly? Bogle identifies the culprit. Emotion. We are our own worst enemies. We get greedy when the market is high, piling in at the top out of FOMO. We get fearful when the market is low, panic selling at the bottom and locking in our losses. We chase performance, pulling money out of a fund that had a bad year and putting it into the fund that was last year's superstar, effectively buying high and selling low. He calls this the investment return versus the investor return gap. The investment return is what a fund reports. It's performance on paper. The investor return is what the actual people in the fund earn, and it's almost always lower. Why? Because investors don't just sit still. They move their money around at precisely the worst times, driven by impulse and headlines. Bogle says that we try to outsmart a market that is, for all intents and purposes, smarter than we are. We hear a news report, we get a hot tip from a friend, we see a stock soaring, and we act. This hyperactivity, this constant trading and tinkering, is what turns a winner's game of long-term owning into the loser's game of short-term speculation. Today's take. This chapter is a perfect description of the meme stock phenomenon. Take GameStop GME in 2021. A wave of retail investors, organized on Reddit's Wall Street bets, piled into the stock, driving its price to absurd heights. Many who got in early made a fortune. But for every one of them, there were thousands who bought in at the peak, caught up in euphoric frenzy, only to see their investment collapse. They were driven by greed, by the story of a rebellion against Wall Street, and by a powerful dose of FOMO. They weren't investing in a business. They were gambling on a moment. The same psychology drives the crypto market. The price of Bitcoin can swing 20% in a single day based on a tweet from a celebrity or a regulatory rumor. People rush in when the price is mooning and panic sell when it crashes. This emotional roller coaster is the polar opposite of Bogle's calm, disciplined, stay-the-course philosophy. Modern technology has weaponized these emotional flaws. Apps with confetti animations for making a trade, social media platforms filled with investment gurus promising 100x returns. They are all designed to encourage activity. Bogle's lesson is to unplug from this noise. The single most important decision you can make after constructing a sound portfolio is to leave it alone. Chapter 4. How to make a winner's game your own. Having explained the problem, Bogle now provides a solution. It is, in his words, majestically simple. If the loser's game is trying to beat the market, the winner's game is to become the market. The way to do this is to own a broad market index fund that holds all the stocks in the U.S. stock market. He champions what is now known as a total stock market index fund. Why this instead of just the S&P 500? Because the S&P 500, while excellent, only represents the 500 largest U.S. companies. A total market fund gives you a piece of those, plus thousands of mid-sized and small companies. It is the ultimate diversification. You are owning the entire American haystack, not just the biggest stalks of hay. The strategy is simple. Choose your asset allocation. Decide on a mix between stocks and bonds that is appropriate for your age, risk tolerance, and financial goals. He covers this more later. Invest in low-cost index funds. Use a total stock market index fund for your stock allocation and a total bond market index fund for your bond allocation. Hold on forever. Tune out the noise, ignore the short-term gyrations, and let the long-term growth of the economy work for you. Rebalance occasionally, perhaps once a year, to maintain your desired asset allocation, but otherwise do nothing. This approach removes ego, emotion, and guesswork from the equation. You no longer have to worry about which stocks will win or which sectors will be hot. You own them all. You are guaranteed to capture the market's return, and by keeping costs at rock bottom, you ensure you keep almost all of it. Today's take. This strategy is the bedrock of the modern passive investing movement. Today, it's easier than ever to implement Bogle's advice. You can open an account with a low-cost provider like Vanguard, Fidelity, or Charles Schwab, and in a matter of minutes, invest in a total stock market ETF like VTI or a mutual fund like VDSEX. This is a core principle behind the Bogle philosophy, a massive online community of investors who follow his teachings. They advocate for simple, 3-fund portfolios, e.g., a U.S. total stock market fund, an international total stock market fund, and a U.S. total bond market fund that provide global diversification with minimal cost and complexity. In an age where everyone is looking for a life hack or a secret shortcut, Bogle's strategy is the ultimate one. It frees you from the need to follow the market daily. It gives you back your time and your peace of mind. It's a profound realization that the most successful investing strategy is also the one that requires the least amount of effort. Chapter 5, The Grand Illusion. This chapter is a direct assault on the idea that you can reliably pick winning mutual fund managers. Bogle presents a powerful metaphor. The market is a giant casino. The house, the market makers, brokers, and fund managers, takes its cut off the top. The players, the investors, are all playing against each other. Some will win in the short term due to luck, just like someone hitting a jackpot on a slot machine. The mutual fund industry promotes these lucky winners as geniuses. They put their faces on magazine covers and run ads touting their #1 performance. Investors, seeing this track record, pour their money in, believing this manager has a special skill. Bogle calls this the grand illusion. He uses data to show that performance doesn't persist. A fund manager who outperforms for one period is statistically no more likely, and is often less likely, to outperform in the next period. This phenomenon is called reversion to mean. Hot streaks turn cold. Winning strategies stop working. The managers who were praised as brilliant are quietly replaced. Bogle argues that trying to find a tiny handful of managers who might beat the market over the long term, a number he believes is statistically close to zero after costs, is a fool's errand. It's like searching for a needle in a haystack. His solution? Just buy the whole haystack. Today's take. The grand illusion is alive and well, it's just changed forms. The new star managers aren't just on Wall Street. They're on YouTube and TikTok. They are financial influencers who build a following by showcasing a few spectacular wins, creating the illusion of genius. They might show you a 10x return on a speculative crypto coin, but conveniently forget to mention the 9 other coins they bought that went to zero. This is the power of survivorship bias. We only hear the success stories. The thousands of day traders who lose money, the hedge funds that go bust, the revolutionary tech companies that fail, they don't make headlines. We are constantly presented with a distorted picture of reality that makes it seem like beating the market is easy, if only you follow the right guru. Bogle's advice cuts through this. When you buy an index fund, you are admitting you don't know the future, and you don't need to. You are betting on human ingenuity as a whole, not on the supposed brilliance of a single person or company. It's a humble approach, but it is also the most statistically sound. Chapter 6. Taxes or costs. 2. Bogle reminds us that for most investors, there are 2 certainties, death and taxes. While management fees and trading commissions are visible costs, taxes are huge, often overlooked, costs that can decimate your returns. Actively managed mutual funds are notoriously tax inefficient. Because their managers are constantly buying and selling stocks, they regularly realize capital gains. At the end of the year, these gains must be distributed to the fund's shareholders, who then have to pay taxes on them, even if they never sold a single share of the fund themselves. This can create a significant tax drag on your portfolio's performance, especially in a taxable brokerage account. Index funds, on the other hand, are remarkably tax efficient. Because their strategy is to buy and hold, they have very low turnover, the rate at which they trade their holdings. They only sell a stock when it's removed from the index. As a result, they realize far fewer capital gains, and their investors face a much lower tax burden year after year. Bogle's point is that it's not what you make that matters. It's what you keep after all costs, including taxes. A low-cost, low-turnover index fund is superior not just because of its low expense ratio, but because it lets you keep more of your money away from the tax man. Today's take. This principle is critically important in the modern era of hyperactive trading. Day traders. People who use platforms like Robinhood to trade in and out of stocks frequently are often hit with a nasty surprise at tax time. If they hold a stock for less than a year, any profit is considered a short-term capital gain, which is taxed at the same high rate as ordinary income. Crypto trading. The same rules apply to cryptocurrencies. Every time you sell a crypto for a profit or even use it to buy something, you are creating a taxable event. The record keeping can be a nightmare, and the tax bills can be substantial. Bogle's buy and hold indexing strategy is the ultimate tax deferral machine. By not selling, you allow your investments to grow tax deferred for years or even decades. You only pay capital gains tax when you finally sell in retirement, and even then, those gains will likely be long-term, which are taxed at a much more favorable rate. It's another boring but incredibly powerful advantage of the common sense approach. Chapter 7. When the good times no longer roll. Markets don't always go up. Bogle dedicates this chapter to the reality of bear markets, crashes, and long periods of stagnation. He cautions investors against irrational exuberance. When stocks have been booming for years, people start to believe that high returns are a new normal. They extrapolate the recent past into the infinite future, a dangerous psychological trap. Bogle introduces a concept of return to the mean in market valuations. Stock returns come from two sources: investment return, the actual business results, earnings growth and dividend yields; speculative return, the change in how much investors are willing to pay for those earnings, the P/E ratio. During a bull market, the P/E ratio expands, meaning the speculative return is high. Investors get excited and pay ever higher prices for the same dollar of earnings. But this can't go on forever. Eventually, valuations revert to the mean. The P/E ratio contracts, and the speculative return becomes negative, causing a market downturn or crash, even if the underlying businesses are still doing fine. Bogle's message is one of tempered expectations. Do not assume the high returns of the past decade will continue. The long-term average return for stocks is around 6.5 to 7% after inflation. Base your financial planning on this realistic number, not on the 20% returns you saw during a bubble. When the good times inevitably end, the disciplined, long-term investor who has stayed the course will be the one who survives and ultimately thrives. Today's take. This chapter is incredibly relevant after the massive bull run that followed the 2008 financial crisis and the 2020 pandemic. We saw sky-high valuations in tech stocks, the rise of story stocks that had no profits but a great narrative, and a general feeling that the market could only go up. The subsequent bear market in 2022 was a harsh reminder of Bogle's lesson. Companies that were once market darlings like Peloton or Zoom saw their stock prices collapse as their growth stories met reality. The speculative froth was blown off the market. Investors who had piled in at the top, believing the hype, were crushed. Bogle would advise us to ignore the market forecasts and the predictions of so-called experts. No one can predict whether the market will go up or down in the short term. The only rational approach is to stick to your asset allocation. Continue to invest regularly, a practice known as dollar cost averaging, and trust in the long-term productivity of the global economy. Don't let the bull market make you greedy, and don't let the bear market make you fearful. Chapter 8. Selecting long-term winners. This chapter, along with the next, forms the core of Bogle's argument against stock picking. Here, he methodically dismantles the idea that you, or even professional, can consistently identify the companies that will be the big winners of the future. He points out that the stock market's returns are concentrated in a surprisingly small number of superstar stocks. A study he cites found that over decades, the best-performing 4% of stocks accounted for all the net wealth creation in the market. The other 96% of stocks, in aggregate, just matched the return of risk-free treasury bills. The challenge, therefore, is to find those few superstar stocks in advance and hold them. The problem? It's nearly impossible. Today's corporate giants are often tomorrow's has-beens. Think of the dominant companies of the past. General Motors, Sears, Eastman, Kodak. All were once considered blue-chip, can't-miss investments. All have since fallen from grace. Bogle argues that for every Apple or Amazon, there are thousands of companies that fail or stagnate. Trying to pick the winners is like trying to find a needle in a haystack. Even if you get lucky and find one, the temptation to sell too early or the risk of being wrong about the next one is enormous. The far simpler and more effective solution is to just buy the entire haystack. Today's take. The modern market reinforces Bogle's point with stunning clarity. Today's market is dominated by a handful of tech megacaps, often called a Magnificent Seven: Apple, Microsoft, Google, Amazon, Nvidia, Tesla, Meta. Their performance has driven a huge portion of the S&P 500's returns in recent years. This leads many investors to believe they should just own these 7 stocks. But Bogle would issue a stern warning. Will these 7 companies still be the dominant players in 20 years? History suggests it's unlikely. Who in the year 2000 would have predicted the downfall of Nokia or the rise of a company like Nvidia to become one of the largest in the world? By owning a total market index fund, you ensure you own the Magnificent Seven today, but you also own the thousands of other companies, one of which might just be the next Nvidia. You don't have to guess. You let the market do the work of sorting the winners from the losers, and you are guaranteed to own the winners along the way. Chapter 9. Yesterday's winners, tomorrow's losers. Bogle doubles down on his attack on performance chasing, this time focusing on mutual funds. He presents overwhelming evidence that picking a mutual fund based on its past performance is a terrible strategy. The data is clear. Funds that are in the top quartile of performance in one period have no better than a random chance of being in the top quartile in the next period. In fact, they are just as likely to end up in the bottom quartile. Why? Reversion to the mean. A fund manager might get lucky with a particular strategy or a hot sector. As their performance soars, new money floods in, making the fund larger and harder to manage. The very conditions that led to their success disappear. The hot sector cools off. Their style of investing goes out of favor. Bogle warns that the mutual fund industry's entire marketing machine is designed to exploit our tendency to chase past performance. They advertise their 5-star funds and their Manager of the Year awards, knowing that investors will follow the money. But it's a trap. By the time you read about a fund's great performance in a magazine, you're likely too late. The party is already ending. Today's take. The story of the ARK Innovation ETF, ARKK, is a quintessential modern example of this chapter. In 2020, ARKK was the hottest fund on the planet, delivering a return of over 150% by investing in disruptive innovation stocks. Its manager, Cathie Wood, was hailed as a visionary. Money poured in from retail investors who saw the incredible past performance and assumed it would continue forever. Then came 2021 and 2022. As interest rates rose, the high-growth, speculative stocks that ARKK owned were decimated. The fund lost over 75% of its value from its peak. The vast majority of investors who had piled in near the top suffered catastrophic losses. Yesterday's biggest winner became tomorrow's biggest loser, just as Bogle predicted. The lesson is stark. Ignore past performance. It tells you absolutely nothing about the future. The only 2 things that Bogle says are predictive of a fund's future returns relative to its peers are its cost and its tax efficiency. Choose the cheapest, most tax-efficient fund, which will almost always be an index fund, and you give yourself the highest probability of success. Chapter 10. Seeking advice to select funds? In this chapter, Bogle takes aim at the financial advisory industry. He acknowledges that many people feel they need help managing their money, but he warns that the advice they receive is often conflicted and expensive. He draws a distinction between 2 types of advisors. Brokers. Traditionally, brokers were paid via commissions. Their incentive was to get you to trade, not necessarily to make you money. The more you bought and sold, the more they earned. Financial advisors. This is a broad category. Some are fee-only fiduciaries who are legally obligated to act in your best interest. Many other, however, are essentially salespeople for high-cost insurance products and mutual funds, earning commissions and fees that are not always transparent. Bogle is deeply skeptical of the value provided by most advisors, especially when it comes to fund selection. If the evidence is so clear that picking winning funds is a loser's game, why would you pay someone a hefty fee to do it for you? He argues that for most people, the simple, low-cost indexing strategy is so straightforward that it largely eliminates the need for expensive, ongoing advice on investment selection. He suggests that if you do seek advice, it should be from a fee-only advisor for specific planning purposes, like retirement planning, estate planning, or tax strategies, rather than for trying to beat the market. Today's take: the advisory landscape has changed, but the core conflicts remain. The rise of robo-advisors like Betterment and Wealthfront offers a lower-cost alternative. They use algorithms to build and manage a portfolio of low-cost ETFs for you, typically for a fee of around 0.25% per year. For many, this is a huge improvement over a high-cost human advisor. However, Bogle would still point out that you are paying a fee for something you could very easily do yourself in about 15 minutes a year. The best advice today is to find a fee-only certified financial planner, CFP, who acts as a fiduciary. You can pay them an hourly rate or a flat fee to help you create a comprehensive financial plan. They can provide immense value in helping you define your goals, optimize your taxes, and ensure your overall financial house is in order. But when it comes to the investment portfolio itself, the best ones will likely tell you to do exactly what Bogle recommends: buy low-cost index funds and stay the course. Beware any advisor who promises to beat the market. They are trying to sell you a ticket to the loser's game. Chapter 11, focus on the lowest cost funds. This is a short but critical chapter that reinforces Bogle's central mantra: costs matter most. He presents more data showing the powerful inverse correlation between a fund's costs and its performance. The lower the expense ratio, the higher the return for the investor. It's that simple. He rails against the industry's tendency to hide and obscure costs. He points to things like 12b-1 fees, marketing fees that come directly out of the fund's assets, soft dollar arrangements, and high trading costs that aren't included in the stated expense ratio. All these layers of cost add up, creating a massive headwind for the investor. Bogle's advice is ruthlessly simple. When choosing a fund within a specific asset class, like large-cap U.S. stocks, line them all up and pick the one with the lowest all-in cost. In almost every case, that will be an index fund. He saw the index fund not just as a product, but as a moral standard, a way to deliver the market's return to investors with maximum efficiency and transparency. Today's take: the race to the bottom on fees, which Bogle himself started, has been a massive victory for investors. Today, you can buy a total stock market index fund or ETF with an expense ratio of 0.04% or even lower. This is practically free. However, the industry continues to invent new ways to charge premium fees. The explosion of ESG, environmental, social, and governance, and other thematic ETFs is a perfect example. These funds cater to investors' values or their desire to invest in a specific trend, but they often carry expense ratios that are 5 to 10 times higher than a simple index fund. Bogle would argue that while your intentions may be good, you are likely sacrificing significant long-term returns for a portfolio that may not even be that different from the total market. Before paying a premium for any special fund, you must ask yourself if the extra cost is truly worth it. More often than not, the answer is no. Stick with the cheapest, broadest funds available. Chapter 12, profit from the majesty of simplicity. In this chapter, Bogle celebrates the elegance and power of keeping things simple. He quotes Leonardo da Vinci: "Simplicity is the ultimate sophistication." Investing, he argues, has been made unnecessarily complex by the financial industry in order to justify its fees. The jargon, the complex products, the endless analysis, it's all designed to make you feel like you need an expert to guide you. Bogle's counterproposal is a portfolio of profound simplicity. For many investors, he suggests a single fund to suffice, a balanced index fund that holds a diversified mix of stocks and bonds, e.g., 60% stocks, 40% bonds, in a fixed allocation. This one fund gives you diversification, low cost, and automatic rebalancing, all in one package. He argues that the more complex a portfolio becomes, the more likely you are to tinker with it, to chase performance among its various parts, and to fall victim to behavioral mistakes he outlined earlier. A simple portfolio is an easy portfolio to stick with. It frees up your time and mental energy to focus on the things that actually matter: your savings rate, your career, and your life. Today's take. The modern equivalent of Bogle's Simple Balance Fund is the Target Date Retirement Fund. These funds are designed to be a single, all-in-one investment for retirement savers. You pick the fund with the year closest to your expected retirement date, e.g., Target Date 2060. The fund starts out heavily invested in stocks and automatically, gradually becomes more conservative by increasing its allocation to bonds as you get closer to retirement. For the vast majority of people saving for retirement in a 401k or IRA, a low-cost target date index fund is the perfect set-it-and-forget-it solution. It embodies Bogle's principles of diversification, low cost, and automation. It's the ultimate expression of profiting from the majesty of simplicity. You make one decision, and the fund's managers, or rather its algorithm, take care of the rest for your entire working life. Chapter 13, Bonds, the often forgotten asset class. While most of the book focuses on stocks, Bogle dedicates this chapter to the crucial role of bonds in a portfolio. He explains a bond to the anchor of a portfolio, providing stability and income to offset the volatility of stocks. He explains the basic mechanics of bonds. When you buy a bond, you're lending money to a government or a corporation. In return, they promise to pay you periodic interest, the coupon, and return your principal at a future date maturity. The primary role of bonds is not necessarily to generate high returns, but to act as a shock absorber. When the stock market crashes, high-quality government bonds often go up in value as investors flee to safety. This cushions the blow to your overall portfolio and gives you a source of stable assets you can sell to cover living expenses without having to sell your stocks at a loss. Just as with stocks, Bogle recommends a low-cost, broadly diversified total bond market index fund. This gives you exposure to thousands of different government and high-quality corporate bonds, minimizing the risk of any single bond defaulting. He warns against reaching for high yields and junk bonds, as you're taking on stock-like risk without the potential for stock-like returns. Today's take. In the low interest rate environment that dominated the 2010s, many investors declared that bonds are dead. They seemed boring and offered pitiful yields. Many younger investors, especially those in the FIRE movement, advocated for 100% stock portfolios. The market turmoil of 2022, when both stocks and bonds fell, further confused people. However, this was a rare historical anomaly caused by a rapid spike in inflation and interest rates. The fundamental role of bonds has not changed. They remain the single best diversifier for a stock portfolio. Your allocation to bonds should depend on your ability, willingness, and need to take risk. An older person in retirement might have a 60-40th or 50-50th portfolio, 50% stocks, 50% bonds, to provide stability and income. A young person with a 40-year time horizon might have a 90-10 or 80-20 portfolio, recognizing that they have plenty of time to recover from stock market downturns. The key is to have some allocation to high-quality bonds to act as your portfolio's anchor to windward. Chapter 14. What about international stocks? Bogle had a somewhat controversial and evolving view on international investing. In the early editions of his book, he argued that U.S. investors didn't necessarily need to own international stocks. His reasoning was that large U.S. corporations like Coca-Cola or Apple are already global businesses, earning a huge portion of their revenue from overseas. By owning a U.S. total stock market fund, you already have significant global economic exposure. He also pointed to the higher costs and currency risks associated with international funds. However, over time, his stance softened. He acknowledged that owning international stocks does provide an additional layer of diversification. There may be long periods where international markets outperform the U.S. market and vice versa. Owning both smooths out your ride. While he never became a passionate advocate for it, he conceded that a reasonable approach would be to allocate a portion of your stock portfolio, perhaps 20% to 30%, to a broad, low-cost total international stock index fund. His main point remained: if you do invest internationally, do it through a low-cost, broadly diversified index fund, not by trying to pick winning countries or companies. Today's take. Today, the consensus among most financial planners and Bogle heads is that global diversification is a